Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me again today is Chris Vermeulen from the Tech Traders. How are you today, Chris?
Hey, I'm good, Tom. How are you?
I'm great. So today is Thursday, June 11th, and we're seeing pretty much red across the big equity markets. Explain to us a little bit about what's going on and the market conditions that we're seeing kind of play out and come to a head here.
Yeah, there's a lot of things that have been kind of giving us some insight that a major market top is going to happen. And I did a video on it last Friday talking about how the market had this huge gap up into above resistance. Sentiment is at this extreme level where the VIX has been fading, showing there's declining fear in the market. People were buying call options, so leverage on the stock market like we haven't seen in years. It was actually the lowest level below what we saw from at the February highs. And when the market gaps up above resistance on huge news, which was that 2.5 million new jobs created, which I think was a false number anyway. I think it's been corrected. But when you have these big moves, it's an exhaustion type of move. And the stock market has been making this rising wedge formation that I talked about, where you get a blow off top. And it's exactly what's happened. If you were to look at the SPY on like the 30-minute chart or the SP 500, just regular trading hours, you'll see it's a perfect exhaustion top. It's an island top, which means price gaps higher in a big way. Everyone starts covering their shorts. People become extremely bullish, and it trades sideways for a couple of days, and then it has a huge gap down and reverses. And that's what we've seen today. Stock market's down anywhere from 1.5% to 4%, depending on the index. And we're starting to see kind of that rollover. And again, there's negative news coming out today about COVID spiking. So it's pretty wild price action. And I think at this point, you need to start turning a little more bearish, because all the signs are there that this trend is coming to an end, this relief rally.
One of the interesting things that I found in that video you were talking about that you put out last Friday is the put to call ratio. So is that kind of showing us a change in momentum?
Yeah, so I look at the put call ratio a little different than a lot of people. I look at the opening price. I kind of track it with an opening price, and I use a moving average, kind of delayed a two period average on the daily chart. So I only see what it's opening at, because it pretty much always moves up throughout the day in most cases. And what that is people are piling in, buying leverage, thinking the stock market is going higher, so they want to ramp up their leverage and get in position. And every morning for the last couple of weeks, or really the last almost 3 months, every week this level, the put call ratio opens lower and lower. And the lower it is, it means the more calls that are being bought, expecting the market to rally. And so the sentiment is just going through the roof, that everyone is thinking the stocks are going higher, that they're not turning around. And when sentiment is at that extreme of a level, that is usually a major contrarian indicator saying, wow, people are super complacent. I mean, I could tell from my email inbox, people were frustrated that the market was still going up and the fundamentals don't make sense. A lot of things don't make sense for those higher prices, but people are really getting frustrated. And there's a huge short position on most of the indexes. But I in that video, I actually showed the short position on the SP 500 futures and how it was actually at a really high net short position. And this was before we had the pop on Friday. Was talking about, we need to see these shorts cover, because the market's not going to collapse if the majority of people are still holding big short positions. And that's what the market did. The market came out with killer news, had a huge move up above resistance. I think all those shorts liquidated last week over the last couple of days. And now the market is cleansed. And now that the shorts are out and they got shaken out, the market should collapse. And so that's where we're at, is this sentiment of everyone being super bullish, and who bought are now about to get kind of hit over the head with another wave of selling.
Yeah, it seems that everybody was had a little bit of FOMO going on, and how do you look at, like, what are some of the indicators that you're seeing or that you like to look at that kind of warns you about that?
Um, yeah, I mean, some of the main indicators I like to follow, other than my inbox and reading comments on videos and articles I post. I mean, you can really tell when FOMO the last few days has just been as thick as butter. I mean, you could cut the air with a knife. How many people were piling in, and even though I was saying, hey, this is like the final blow off, this is supposed to get you all rattled and emotional and to suck you in. Like, people who weren't long were buying the last few days, just saying, I can't take it anymore. I'm just going to buy into the market. The shorts were saying the same thing. I can't take this loss anymore. And that's what the market does. So unfortunately, the comments are a really major indicator. And when I take a ton of heat for going against the grain, that's usually a major turning point. And that's what has been happening. But we've also seen other things, other indicators point to leading leading that the market is topping, which is precious metals and the miners have been coming to life. We've had some big down days in the market, or some days where the stock market had intraday sell-offs. And during those sell-offs in the stock market, we would see gold and miners really turn around and start to rally. So they're now seen as a safe haven play. And considering the stock market's down big today, gold is up 1.77%, silver's up 2.7. Gold miners are down a little bit, but considering they're an equity that typically gets pulled down with stocks a little bit, they're actually bucking the trend and holding up exceptionally well. So, and also bonds have been outperforming the last few sessions, and that is another indicator that we're ready for this shift to the downside, because when everyone's moving out of bonds and everyone's extra bullish buying leverage on stocks, that is like the peak kind of optimism in the market that that bubble needs to be popped. And that's what's happening this week, is we're getting that unwinding effect of everyone chasing prices. If you chase prices, whatever goes straight up usually comes straight back down. That's just the way the markets move, and that's what we're seeing.
So as we've seen gold, even for the past 30 days, kind of bounce around in this channel right around 1700, are we kind of expecting another move up with this sell-off?
Yeah, I mean, it's a very bullish formation that has formed from the lows in March to the highs in April, and then the recent kind of lower end of that range. I mean, if this pattern plays out, the next move is going to be 1867 on gold, somewhere in that range. That's a Fibonacci measured move for the first kind of resistance area, and then after that it goes right to 1990, so almost pretty much $2,000 mark. So this is a big pattern. If the stock market starts to roll over and potentially goes for that double dip, I mean, we're going to see money definitely flood to the safe havens, and I think that could send not only gold but bonds higher, because they both have a very similar chart pattern.
Excellent. And we've seen silver break back above $18 this morning. Do you think that there's a lot more potential for silver to take off here?
Yeah, I think silver percentage wise, definitely, if it can break out, it really needs to get above like 19, and you could argue it needs to get above 1977. If it can get above those levels, which is still a little ways away from where we're at, I think that'll be the start of a new bull market, and it could go ballistic. It could go like a 2010 is kind of what I'm feeling, where it can go from pretty much the exact price it's at right now, $18, and it rallied all the way up to $49. So I think we're kind of poised and ready. There's all these issues with, I mean, everyone's kind of known forever that the metals markets are manipulated. Silver's got these record short positions. I mean, what's going to happen when they have to actually get called and they start covering their shorts and there's no delivery of physical? I mean, we could get that 2010, blow off spike that is just major payday for anyone holding physical and anyone in potentially silver miners. So I do think it's going to be explosive, but it needs to break into a bull market first, and it's not there just yet.
As we were talking before the call, we were talking about oil and how it's not typically associated with momentum plays. Can you share with us your thoughts on what we're seeing in the oil market as well?
Sure. Yeah. So Oil typically chops around on the daily chart and works its way higher and lower, and it usually kind of cleanses itself. It's kind of, zigzagging around. Well, what we've seen since crude went negative is it's attracted a lot of momentum traders, very aggressive, shorter term traders looking for big gains. And so they've all been piling in, and I think it's attracted a new breed of traders in that commodity. And when you look at the price, it's had a very strong rally. Each rally is followed by really just a small sideways pause. We haven't had any pullbacks yet. And so this is a pure momentum move. Today it's having a pullback or a part of a pause. But if it starts selling off a little bit too much here, all those people who are just holding on and riding this momentum up for everything it's worth, when it starts to roll and they feel like that momentum trade is done, there's going to be thousands of traders around the world just moving out of this kind of rare opportunity that's never been seen before in April. All these people are just move out of that trade, and I think crude could collapse very quickly. Just like if you're trading a small cap momentum stock, they have these massive momentum runs with rally, pause, and then eventually it's going to have a very sharp correction when everybody just jumps off the boat and they're like, that was a fun, cool oil trade. I'm done with oil. I'm going back to what I'm normally doing. So there's a batch of traders in there that I think are going to just dump the position when it starts to roll, and it's going to really kill the price of crude.
What else are you watching right now, Chris, that you think that maybe needs some more attention?
I like natural gas. Natural gas is up today, and I talk about this with subscribers all the time, is when there's fear in the market, when the stock market's crashing, we tend to see natural gas move higher, and that's what it's doing. Yesterday, it actually put in a really big reversal day. It had a big washout low in overnight trading and then rallied back up to close in the upper end of its range. Today, it's getting some carryover buying, and we'll see if it can get some traction. But it's something that's just starting to come to life. It's got potential to pop. Seasonality-wise, second half of June, we usually see a pop in natural gas. So timing-wise, everything is kind of lining up there. In terms of bonds, I think bonds are very similar to a gold play. I think they're going to be seen as a safe haven. They're probably going to start to outperform and move higher with gold and buck the trend of what the Nasdaq or the stock market is doing. So I think there's going to be a flight to safe, not directly linked to the stock market like natural gas. Adds some diversification and some opportunity.
So before the call, Chris, we were talking about everything kind of seems primed and ready for a second COVID wave. And just scrolling through this morning, I'm seeing, more. It started with one news story, and now I've seen two or three pop up about a second wave of COVID coming up. How do you see this progressing through the summer in the, let's say, the general equity markets, and then contrast that with the gold market?
Yeah, it's really tough to forecast out because we don't know what's going to happen. But I mean, just stepping back, if COVID, the news out this morning is 21 states are showing a spike in COVID cases. Oh, go figure. Like, I don't know how they didn't expect, or people didn't expect this to happen. I mean, they've been buying stocks like they're never coming back down, and suddenly they realize, it's starting to spread now that we're all mingling together. Overall, though, if it spikes a little bit more or too much, then they're going to start tightening on rules again. Businesses are going to have to start closing and locking up, and that means we're going on for another month or two of lockdowns, which is another quarter of earnings right out the window. That's going to kill earnings. Fundamentals will make even less sense for these prices, and it's going to create so much chaos. Unfortunately, millions of people are unemployed. They still have bills to pay. They still have food to buy. It's creating chaos. Look at the movement and the riots going on. It doesn't take people are being sparked to do things and to join, riots and events because they don't know what to do. People are frustrated at home, teaching their kids and not having money, and things are starting to get pretty ugly. And another wave of COVID could really ramp up serious psychology damage and get people becoming a little more ugly. And it's kind of a really scary thought if COVID carries on and things close down, what could happen? I mean, this is the time when you buy your gold, you buy your gun, buy your extra, food in case things have to close down and riots start happening and people start stealing, right? I mean, that's extreme. I don't want to go. I mean, not saying that's going to happen, but it is a possibility. It's something you do have to kind of think about.
Well, it seems a lot of positive indicators for gold price, let's say, right?
Well, yeah, if things continue to crumble, there's going to be more fiscal stimulus, which means more printing, which means devaluing the dollar, which means higher gold. So all these things to me are good for gold. And that's why I think gold, silver miners should do really well going forward through this. It's kind of a win-win. If the markets hold up, we'll continue to see, I think, gold stay in an elevated state because it's not just an American safe haven. It is a global safe haven. People around the world are buying gold. And then if the markets do start to crash, the stock market, the Fed's going to do more stimulus and it's going to create more fear to go to gold. But then the stimulus also powers gold to go higher. So I feel like it's kind of a win-win. No matter what happens, it should hold up. Worst case or best case scenario, it explodes and continues to go higher. So,
excellent, Chris. Any final thoughts as we wrap up?
No, I think that's about it. We've been in this no man's land with the stock market between the SP 500 between February high and the March lows. We're very close to potentially running out of steam here and watching the stock market, go into another COVID sell-off. And the big question is, do we have a double dip? And what do you do with your long-term investment positions? And that's the big thing I'm really trying to push right now is you need to make sure you're on top of your long-term retirement accounts, because if you play these moves right going forward, you could retire, 5, 10, 20 years early if you can profit from the potential bear market, or you get back into the new bull market if one starts and you're in the right assets and the right balanced portfolio. So this is a huge turning point, and the market is still another week or 5 weeks away, I think, from giving us a major signal. The last time we talked, I think we were about 6 or 8 weeks away based on my signals and my system saying we're really close to a new investment signal, whether it's a renewed bull market or the start of a bear market. And so we're closer to that now. We're weeks away from a new major signal. And so I think investors need to make sure they're positioned right, because I think, Buffett talked about this about a week and a half ago. He went on and he talked about why he's got record amounts of cash, and he did it in a very subtle way. But if you read between the lines and the tone of his voice, he can see something so bad coming that he literally is liquidating and holding so much cash because he obviously is not trusting the financial system. He is worried about COVID. So that's my big concern, is this 35% drop we saw on the first wave of COVID could look like child's play, and it could be amazing for precious metals and miners if they go absolutely ballistic with all the printing and the devaluation of the dollar that will come to play eventually. I mean, it's already sold off. Zero rates, printing, to infinity and beyond is good for gold.
Absolutely. And just to pick up on something you said there, you're saying to position for the bear market that's coming. So how are you doing that, and how are you thinking about that? Are you shorting certain things, or how do you go about doing that?
All right. So just to be clear, I don't pick tops and I don't pick bottoms. So I'm not betting against the market right now. I'm preparing for when I get a signal to play an inverse ETF. I think the way to play a bear market, if we get one, which it's not for sure that we're going to get one. The market always does, its own, it kind of dances at its own beat. So you never know which way it's going to go. But if we get a bear market, I think the best way to play it is through an inverse ETF. I mean, you can get long bonds, but really they don't perform very well. And actually they'll perform okay right at the beginning of a bear market, but then they kind of flatline and chop around, are very valueless for months on end, even sometimes a year or so. And they come back to life right at the very end of a bear market when everyone throws in the hat on stocks. They say, forget it, put me in bonds. And bonds is a very good leading indicator to when a stock market bottom is coming. But the best way to trade it is to play an inverse ETF on the stock market. So it'll rise in value when the stock market falls. And that is really kind of the best way to play it. Anyone can buy an inverse ETF. You don't need any leverage. You can buy like the non-leveraged inverse, like SH on the SP 500. So that's kind of the way to play a bear market. You get the most bang for your buck, the most opportunity, and it's really simple to do. You just need to know when we're in a bear market, and then also when certain targets are being reached, when to pull some money off, and when to switch back to bull market mode and prepare for a multi-year rally and another wave of wealth.
Excellent. Some great information there. Of course, we can find you on Twitter at the Tech Traders and your website, thetechnicaltraders.com. Thanks for your time today, Chris.
Hey, thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?